Okay, this is Dr. Payne again. We're going to talk about this time the basic income statement. And again, we're going to learn some items on the income statement that we're going to need to be able to calculate some of these ratios for a financial statement analysis. So I have a basic income statement on my whiteboard. And I'll go through these elements. I know it's not real easy to see, but I'm going to explain what these are. So we have the income statement at the top. And as I said earlier, the income statement is for a period of time. So this is for the year ended 12/31/X. So it's for a full year. First item is revenue, net sales, and that's going to be net of discounts or allowances. So net sales, 750. And then the cost of goods sold. Cost of goods sold is when a company buys inventory, when that inventory gets sold, the cost, the cost of that inventory moves from the balance sheet account, the inventory account, into cost of goods sold because it's the cost of the goods that were sold. Okay, so that's how much it cost us to buy or manufacture, if we manufactured it, that those goods that were sold. So we sold it for 750. It cost us 600,000 to either buy it or make it. So we had a gross profit, and that's the formula. Sales minus cost of goods sold is equal to gross profit, a gross profit of 150. So that's our next item. Then we have fixed operating costs, except depreciation. Depreciation is it's a kind of a special element because it is the using up of a fixed asset, and it's based on an estimate. So it's nothing other than estimating how long property, plant, and equipment. So buildings, machinery, assets that we're using in the business, how long they're going to last, and allocating their cost over their estimated useful life. So it's just an estimate. It's not an outlay of cash. So it's a special item. So we keep it separate. So this is other fixed operating costs, cost of operating the business, except depreciation. Then we come down to the next element. We subtract that from the gross profit, and that gives us EBITDA, earnings before interest, taxes, depreciation, and amortization. So we affectionately call that EBITDA, EBITDA, and that's an important number. We're going to use that in some ratios. Then next we have our depreciation. Subtract that from our EBITDA, and that gives us net operating income, or EBIT, earnings before interest and taxes, EBIT. Then we have interest. Subtract the interest, and that gives us earnings before taxes, or EBT, earnings before taxes. Then we have our tax amount, and in this case, we're using a 40% rate for income taxes. Of course, we know that in the real world, the tax rate is not a flat rate like that, but we can calculate a rate, an estimate, or a overall rate based on an estimated net income for the year, based and the amount of income taxes that there would be for that income. So even though it's a graduated table, the rates are actually varying based on the size of the income. We would use the total income tax from the table and divide that by the total net income to get an average rate. So in this case, we're using an estimate or an average of 40% for income taxes. So we multiply that times earnings before taxes. That gives us our tax amount. So in this case, it was 45. Multiply that times 40%. So it's 18 is our tax. And then if we subtract that, that gives us net income. So you can see that if we wanted to calculate EBT from net income, we would simply add that additional 40% back on there. So we would take the 27 and divide it by the reciprocal, 1 minus t. 27 divided by 1 minus t would be 0.6, and that takes us back to the $45. So we're going to have problems. We're going to have to go and calculate these different numbers, and we'll be able to back into it. Another example, if we had EBT and wanted to get to EBIT, and we knew how much notes we had outstanding and the rate, we'd be able to calculate the interest, and then we could uh, add that back to the EBT to get EBIT. And then if we could calculate the depreciation, we could add that to EBIT in order to get EBITDA. If we knew what the gross profit was and the net sales, we could calculate the cost of goods sold. So we're going to learn how to manipulate to use these numbers so that we can calculate the missing elements. So that's the basic income statement.